How does a lender decide how much to lend to your business? Business funding is determined basically by looking at your revenue compared to your debt and seeing how much you can afford. When you apply for business funding, the application will ask you a few common questions like, how long have you been in business? What's your credit score? What's your monthly revenue? When you answer these questions, those answers are plugged into a formula called the debt service coverage ratio, or DSCR. The DSCR is similar to a debt to income ratio that's calculated when you apply for a mortgage. It makes sure you're not borrowing more than you can afford. The DSCR is calculated by dividing your net operating income, which is your revenue minus your expenses, by your debt service, which is the total of all existing debt, all over the same period of time. The minimum that most lenders look for is a DSCR of 1.25. For example, let's say your business brings in $100,000 a year after expenses, and your debt service over the same period is $30,000. Your DSCR would be a 3.33, which is far above the 1.25 minimum that most lenders are looking for. However, if you've already owed $90,000, your DSCR would be 1.11, which means you most likely wouldn't qualify for additional debt. Not all lenders are the same though, and some have different requirements or different ways to calculate net operating income. Lenders will often ask for several months of bank statements and even sometimes several years of tax statements to make sure that your business is trending in the right direction and that you'll be able to pay back essentially the debt that you borrowed. The most straightforward ways to improve the amount you can borrow are to increase your revenue, decrease your expenses, pay down existing debt, and increase your credit score, which usually reduces the amount of interest you pay on a loan. The good news is those are things you're probably already focused on. So best of luck and keep up the hard work on your way to business financing.